tax deduction or not, depends on your individual tax situation, meaning with an IRA. So like I mentioned before, if you don't have a employer retirement plan, at your job, regardless of your income, you could, take the deduction on IRA, right? If you continue to do this for, 29 years, automatic, you don't have to think about it, worry about it, right? So at the end, hi everyone, this is Hareesha from H&B Premier Tax and Accounting LLC. Today I want to bring you guys a cool, simple tax hack that if you follow this, carefully, that you could become a millionaire. Actually, save more than $1 million, if you follow this, right. This is not a get rich quick, thing, or this is not something that I'm trying to sell you a course or anything. This is a simple strategy that I talk to most of my clients every year when they come to prepare their tax returns, and also this is a strategy that we implement with a lot of our business clients every year, so they get the advantage of the tax code, and at the same time they build their wealth, and increase their investments. So let's dive into it. What is this? It's not a secret, it's well known, and most people know about this, and most people have heard about this, but very few actually take advantage of this provision. It's called a IRA, individual retirement arrangement. That's what IRA stands for. There are different kinds of IRAs. You have traditional IRAs and Roth IRAs. Mainly, and then if you are a business owner, you could take advantage of other IRAs such as a simple IRA, SEP IRA. I'm not going to go into those things. I'm just going to talk about the traditional IRA today, because the traditional IRA is the IRA that anybody could set up, and then also take a tax deduction for the contributions that you're making to the IRA. So if you are able to get a tax deduction or not, depends on your individual tax situation, meaning if you have a 401k or retirement plan at your job or not. But for anybody that doesn't have a retirement plan at the job, pension, 401k, 403b, any kind of retirement plan at the job, regardless of income limit, you could contribute money to a traditional IRA and take a deduction. So higher the income you have, you're going to be a higher tax bracket, and then contributing money to a traditional IRA makes all the sense, because you are saving a lot of tax dollars. So for example, I'm going to show you an example in a real tax return, right, how this works. If somebody makes $55,000 a year, now they decide to put money into a traditional IRA, right? So that would be $6,000 for 2020, and that will save them more than $1,300 in taxes. If the person lives in New York, or including federal and state savings, right? So that's almost 22% immediate return on your money. So when I sit down with clients and they review the tax returns, I always point out to them, like, look, this is something that you could do. And you could do this, all the way up to the tax filing deadline. And I point out to them, but what happens is, most of the time, they don't have the money at that point. So that's why we're going to talk today. So what are the limits for the year, and then how you could automate, and then if you follow this for long term, how much money you're going to save for IRA. So what are the limits for 2020 and then 2021, for both tax years? You could put away, if you are below 50 years of age, you could put away $6,000 per person, right? So that means you could literally invest $500 every month, and then max out your IRA if you're below 50. Now, what happens, if you are above 50 years old, and then, you could put away up to $7,000. So you get $1,000 catch-up contribution. So you could put away additional $1,000, right? So now what you need to have earn income to contribute to an IRA. You need to have salaries, wages, bonuses, or commissions, or you need to have a self-employment income, meaning like you're doing your own business, or driving Uber, taxi, or doing like gig economy. So you have to have some kind of self-employment income. If as long as you have earned income, so your contributions could be maximum $6,000 up to your earned income. For example, if somebody makes only $4,000 on a W-2, so then you could put away only up to $4,000. But let's say you're making $10,000, so then at that point you could do if as long as you're below 50 years of age, you could do maximum $6,000. All right. So now, what is not considered earned income when it's come to contributing money to an IRA? Interest income, dividend income, any kind of investment income is not considered as earned income. And then also, if you have properties, the income coming from properties are not considered. Rental income is not considered earned income when you're considering towards contributing to an IRA. And also, if you are a shareholder, or if you're an owner of an S corporation, the income comes from the S corporation Schedule K1 is not considered as earned income when it comes to IRA contribution. Let's see how the tax deductibility works with an IRA. So, like I mentioned before, if you don't have a employer retirement plan, at your job, regardless of your income, you could take the deduction on IRA. Like you could make $1 million and still contribute to an IRA and take a deduction, right? But let's say your job offers you a retirement plan, and then up to what limit you could take a deduction. If you are your filing status single, and then your job your income is less than $65,000 for 2020 tax year, you could still contribute to your employer retirement plan and then take a full deduction on your IRA, traditional IRA. All right. So let's say you're married filing jointly, right? And then when you married filing jointly, you and your spouse both has retirement plans at your job, and your combined income is $104,000 or less, then still you could take a full deduction on your traditional IRA contribution. So then you could have a situation where you are working, your job offers you a retirement plan, but your wife or your spouse's job doesn't offer you a retirement plan. So in that case, your combined income could be all the way up to $196,000, and still you could take a deduction on traditional IRA contribution, right? And then you come to the last filing status, married filing separately. So this is not a favorable filing status for most people. So if you are married filing separately, as long as your income is below $10,000, right, you could take a partial deduction. So I'm going to show you a table on the screen that shows this deduction limits depending on different filing status. You will see it clearly on that table, full deduction, partial deduction, and then at what income limit your deduction goes away. So now let's look at an actual tax return and see how much one could save. This is incredible, because most people don't take advantage of these legitimate tax provisions in our tax code that allows people to save a lot of money and get the benefit. Let's look at actual tax return. All right, so here we are. I created this a tax return for John Doe. Actually, John Doe is not a real person, so but the numbers are real, and this is a real tax return, right? in the sense like, the calculations are actual calculations. No individual, actual individuals information here. So now in this, tax returns for 2020 tax year, right? This person earns, 55,000. That's their income, and then married filing status is a single. All right. So now I calculated the return, without contributing money to an IRA. So if you look at here on top, it will show you the refund is $832 from the federal, and the New York State. This is obviously, I'm in New York, so that's why I picked the New York State. So the New York State refund is $397. So altogether, their refund, will be $1,229. Now let's go and make sure that they contribute money to the IRA. All right. So I'm going to make sure that they contribute, and then they max out the IRA contribution. So when they max out the IRA contribution, requested the system to calculate as if they they contributed $6,000 to IRA already, or as if they were going to contribute before the tax filing due date. So now the calculations after they contributed to the IRA, you will see here, you see their income is still 55,000, and then they're getting a reduction of their income from 55,000, and then reduce 6,000, and they are now adjusted gross income becomes like 49,000, right? So their taxable income effectively go down by $6,000. So now look at their refund. Their federal refund is $1,800, and then their state refund is $763. So now instead of getting $1,229 refund, they're getting $2,565 refund. So that's almost like $1,300 savings. To be exact, $1,336 savings, right? So now what did they have to do to get this savings? They had to put $6,000 into their own individual retirement account and invest their money. So now actually in reality they all needed was only $4,664 to invest $6,000. So right there is like almost like 20%, more than 20%, like 29%, return on your money right then and there. So this is why I tell people it's crazy not to do this, right? Because if you don't put money into a traditional IRA or tax deferred account, IRS is going to tax you for their money. So now this gives you an opportunity to save lots of money tax deferred, and then grow money tax deferred. So also this way you will have more money compounded over the years. I mean, there's a lot of debates which one is better. It's better to put money into a Roth IRA or traditional IRA, but historical data shows that if you put money into a traditional IRA, it will grow much bigger than you putting money into a Roth IRA, because you don't have to pay taxes and then invest money. You invest money pre-tax. All right. So now let's see how if someone continued to do this for many years, right? So I went to this website. It's bankrate.com. Most people are familiar with this website. It has a calculator that shows you how much money you will end up having if you continue a certain type of investment, right? So you could see here. So I took somebody putting $6,000 to an IRA, and then also continuing $500 every month. So that means every month you put $500. That means for the year you will have invested $6,000. So you continue this, investment and takes the tax deduction, right? And then put that money, invest that money into S&P 500. So what is, the S&P 500 index, has returned over the years. It's 10%. But you could pick any investment. You could have a higher return or lesser return, but this is just for calculation purposes. I'm not giving any investment advice. I'm just showing you what's possible here. All right, so let's assume 10% return, and then you do this for 29 years, right? If you continue to do this for 29 years, automatic, you don't have to think about it, worry about it, right? So at the end you would have $1,034,000 saved. Let's say somebody starts at their late 20s, early 30, and then by the time you're ready to retire, that will be additional $1 million. How much that would change your life? Isn't that crazy, right? But most people don't take advantage of this. You saw that in the actual calculation, actual return, that how much of taxes that one could save contributing money to a traditional IRA. And not only that, you saw that if someone continued to do this, year after year, how much money they will accumulate in their retirement savings. So this is very powerful. But the challenge with most people is they don't think long term. They think about year or two, and then they say, oh, it's not a lot. But one thing I realized over the years working with many clients, and then I have a lot of clients that are very, very wealthy clients. What they do, they take a very long-term, perspective about life, investments, taxes, and everything that they do. So once you do that, and these little things that you do year after year compound over time, and then they add up to very, very big numbers. And that's why I encourage you to sit down with your accountant, CPA, attorney, tax advisor, financial planner, and have a discussion if this is something that you could implement, you could follow, and take advantage of tax benefits, at the same time increase your savings, retirement savings, your net worth. This way you will be better financially prepared to retire one day, whenever you're ready to do that. I encourage everyone to take advantage of this, because most people will get to the tax time, and then go give the documents to prepare, say prepare my tax return, and then they will talk to that person next year. No, you want to build a relationship with your accountant, your tax preparer, tax planner, advisor. That's how you get the most advantage of these kind of tax provisions in the tax code. And also what I encourage most people to do, even my own clients, to do it this monthly. You don't have to wait till tax time to put money into an IRA. You could do it monthly. Now if you're below 50, the maximum limit is $6,000. As long as you have more than $6,000 in income, you could automate it. You could put $500 on automatic investment program that's going into your IRA every month, right? So once you automate it, you don't have to worry about it. And then at the end of the year, you will get you have to tell your tax accountant or preparer to take the deduction. So that way you that this will get done. All right. So if you see value in content like this, please like and subscribe to this video, and share it with people that and especially young kids that have a job, work, and then have income still. They live with parents. They don't have any expenses, or have a lot of disposable income. They should take advantage of these kind of setups all the time. All right. So if you have any specific questions about your situation, always feel free to reach out to us. You could reach to us on our Facebook account, or through our website. Send us an email or give us a call. Thanks. Until I see you in the next video, Stay safe, take care of one another.